Hello, I'm Mijun from American Current Affairs University. Mijun broadcast begins Saturday, August 23rd. It's been a really long time since both Kim Min-jung and I have appeared on screen together. This must look quite unfamiliar to you all. It feels like I've been away from the Mijun channel for a really long time, but it was actually just 2 weeks. Still, it felt like a long time away. During that period, Kim Min-jung took care of the Mijun channel like it was his own, and today we've invited him back again. Hello, sir.
Hello, sir. Congratulations on moving to a new place, and I hope everything you do there goes well. I stopped by while you were away, and it felt a bit like being in a house without its owner, just doing something briefly and leaving, so I always feel uneasy and wish you would come back soon. I feel the same way. There needs to be an owner who keeps things centered, but even though you're taking a short break, you're also moving. I'll help you. I'm glad I could offer even a little help.
You're being very humble, but I kept reading the comments consistently and I would leave a heart to show I read them. And I really liked those comments. So even while I was away, you kept uploading great videos so that Mijun subscribers could continue to enjoy quality content, and you kept supporting the Mijun channel. I want to take this opportunity to sincerely thank you again. Thank you. If you come visit here later or if I go to Korea, I'll treat you to a drink.
Yes, thank you.
We had been continuing this series called American Stock Elementary School for a while, then took a break, but today we're starting American Stock Elementary School again. Until last week, we studied various aspects of financial statements from different perspectives, and it wasn't easy. Honestly, I think many of you probably found it quite difficult. But the good thing about YouTube is that you can always go back and review the lessons anytime, so I think it would be good to watch today's video while reviewing what you've learned before. All right, so we can say that this is the start of the second part of the elementary school series. In this new American Stock Elementary School, what topics are you planning to start with?
Yes, up until last time, I mainly talked about how things like financial statements and company performance, which are part of a company's fundamentals, affect stock prices and how to find good investment points. Starting from part 2 today, I plan to focus more on investment indicators. So I'll explain what these investment indicators mean. Also, especially in terms of valuation, there are various indicators, and I'll talk about how you can actually use those indicators. I'll also organize and explain which valuation indicators are good to look at depending on the industry or the growth stage of a company, so that you can easily understand these indicators and valuations.
Yes, personally, I'm really looking forward to it. Also, I think Mijun's subscribers will be able to enjoy watching it even more. In the last 5 years, Mijun's channel hasn't covered many financial statement topics. So, despite Chief Executive Officer Kim In-jung teaching us how to read them, much remained unfamiliar. Starting today, we'll study indicators we've already covered often on Mijun's channel, especially when watching Shikinapa. So, for many of you, this might be more like a review. For those of you who have recently started subscribing, Chief Executive Officer Kim In-jung will explain everything step by step from the basics, so you don't have to worry and can just follow along. Please continue with your prepared material for today.
Yes, thank you. You can see the screen, right? Yes.
It's neat.
Since we're starting part 2, I've changed the thumbnail to something new. Yes, I changed it, and honestly, I was thinking about what to cover as the first indicator. Among the valuation methods, people use PR the most. Even just with PR, there are so many practical ways to use it, and there are even entire books dedicated to PR alone. So if we're going to start with PER, first we need to understand what valuation is and also look at how the terms we commonly use in valuation are actually used in the market. I think it's important to distinguish these aspects. the definition of that part and what I consider to be very important. Benjamin Graham emphasized two key concepts, margin of safety and Mr. Market. Margin of safety concerns valuation, while Mr. Market relates to supply and demand analysis. Usually, when people talk about value investing, they say you don't look at charts, but since Mr. Market actually contains that concept, Graham also says these two things are the most important. So I will explain these concepts, and finally, I'll briefly show you how to look at valuation using about 4 real company examples. From next time, I'll start by talking about PAR from the very basics and go through each part step by step. Yes, that's good. Well, I've explained valuation many times, but basically it's about weighing value and price on a scale and comparing the two. The price is something we can always check because it's constantly being traded in the market, but the real issue is always the value. So the market tells us the price every day, but since it doesn't tell us the value every day, we have to estimate what the value might be. That's why we add station to value and call it valuation. The term valuation itself doesn't mean an exact value. So you compare the estimated company value with the current price, and based on that, you decide whether to buy or sell, or whether it's cheap or expensive. That's what valuation is all about. Next, when we talk about what this value actually is, it's mainly things like sales, profits, cash, and so on. So the ratio that measures a company's value based on its sales is what we usually call the price to sales ratio. The S here stands for sales, which means revenue. Profit is earnings, so that's per. Cash flow is cash flow, so that's profit cash flow ratio. So when valuing a company, you have to decide whether to base the valuation on sales, on earnings, or on capital, which is called book value, the B. Then it becomes PBR. So in the end, valuation is about finding the multiple that focuses on the value a company is producing. That's how you should see it. So in practice, how do I estimate or determine this valuation? That's the real world issue, and I'll explain it step by step throughout this introductory course. First of all, there's one thing you really need to distinguish in valuation terminology. In the market, these two things are most often confused. Fair stock price and target stock price are different, but people often confuse them, which causes misunderstanding. Before I continue, it's important to first distinguish between these two things. When discussing fair stock price, that we use fair value in English. For target stock price, and then we say target price, not target value. So since one uses price and the other uses value, it's correct to see them as different concepts. So the target stock price is generally the price that analysts expect a stock to reach within a year, or at most a year and a half, in order to achieve a good return. That's what we call the target price. So you need to understand that it's a slightly different concept from the company's intrinsic value or true essence. That way, when there's a gap between the target price and other factors later on, you'll know how to make your own judgment. So the target price is defined as the price expected to be reached in 12 months or a year. Next, the fair price is a term that's actually used in a way that's quite similar to this concept in general. Intrinsic value, also called intrinsic value, is the term most commonly used when doing valuation. The term in English is intrinsic value, but in our daily lives or in reports, we hardly ever use the term intrinsic value in Korean. Since we don't use it, the term sounds like a very unfamiliar concept, but let's make it easier to understand. Generally, the value we use on our site can be understood as the fair stock price. So on choice stock, the value labeled as fair stock price is not the target price, but the intrinsic value. But if we just write intrinsic value, people ask, what does that even mean? That's why we currently call it the fair stock price. So the fair value listed as fair value on our site and the target price suggested by analysts are different. First of all, you should know that these two values are a bit different. Later, you'll be able to clearly understand how to interpret the difference between the value on our site and the target price provided by securities firms or seeking alpha. So I think it would be good for you to understand that concept first, and then as for market value, you can just hear it now and forget about it, because it's a term that's hardly ever used. But when people say market value, in reality, they're talking about market capitalization. Even though it's written as market value in English, the correct term is market cap, and this is actually market price. This isn't truly value, it's about price, like market capitalization. Market value differs from valuation. It's simply the current market trading price or market capitalization. When you're doing an actual valuation, what you need to remember is these two things. The proper stock price is about valuing the actual value that a company is generating. The target stock price is based on that and refers to the price expected to be reached within the next year. So if you keep the two concepts of proper stock price and target stock price in mind as we start, it will help you understand the explanations that follow. This is the first screen, and it shows information related to brokerage firms' target prices provided by a site called TipRanks. So if you look here, it shows how this company's stock price has traded over the past year, and it predicts how it will trade over the next year in 3 different scenarios. Among all the prices set by brokerage analysts, the highest one is $230 and the lowest is $120. The difference between these two is huge. So depending on where the stock price ends up in a year, one of those two analysts might have to pack their bags because that's how big the difference is. The analyst predicting $120 expects the stock now at $180 to face a major correction, while the $230 prediction sees more growth ahead. And the average value that these analysts came up with is $183. This is what's shown here, and it's the target price that's applied on most foreign and Korean websites. So the target price is not a value set by a specific analyst. So each person can come up with their own target price individually, and that would be their own target price. But the value we usually see on websites is an average value, since several people would have provided their target prices. Whether it's 30 people or 50 people, they all submitted their target prices. Here, you can see it says 37 people, but 37 people, 37 individuals. They're saying that the average price expected to be reached within 12 months is about $183. Since the current price is $140, they're saying it's overvalued by about 0.62%. So basically, you won't see any returns within a year. That's actually the concept behind this target price. That's how it's structured. Next, for the second part, I also looked up the screen on Seeking Alpha. I too am Mi Ji-yoon. When you held that event, Chief Executive Officer, I personally signed up for Seeking Alpha as well. I wanted to see what the strengths of Seeking Alpha are and what areas we need to improve on. It's a competitor, right? So I looked up the same company, Advanced Micro Devices, on Seeking Alpha. If you look here, the chart is almost the same. So unlike the previous one, this isn't a price target made by Seeking Alpha. There are data providers that offer the average value by aggregating all the target prices from securities firms. Those sites, whether it's Seeking Alpha, TipRanks, or Market Screener, just use that value by getting the data feed. That's how you can look at it. So what's important is that the valuation wasn't created by those sites themselves. Next, if you look here, I checked over a longer period. This is an indicator that shows how Wall Street analysts' investment opinions have changed over 3 years. As you can see, there hasn't been a single sell or strong sell during that time. There hasn't been any for 3 years, so if you buy it, you basically keep it forever. Because it's always a buy. At this time, it's a buy. At that time, it's a buy. And again, it's a buy. So no matter when you look, it'll always be a buy. So I might have said it a bit jokingly, but if you check most companies, you'll see that over 80% of all stocks currently have a buy investment rating. That means it's a buy even when it's overvalued, and a buy when it's undervalued. That's why, with this kind of target price system, individual investors end up not really using it as a reference when they invest. Even if they do refer to it, they wonder if it's actually reliable. The target price is always higher than the current price. When the stock price goes up, the target price goes up with it, and if it looks like it's going to fall, somehow the target price follows it down. And so when you think about whether this is really a leading indicator or the actual price it should return to, you really start to feel a lot of limitations. Our site was also very well aware of those limitations. We thought we needed to develop our own valuation models and do the calculations ourselves, and that we needed to find some meaning as a leading indicator for these valuation type charts to be meaningful. So we decided to go in the direction of doing our own valuations. In the case of the United States, there is one place that's doing it, but I'll explain that later in this presentation. This is a chart where I've plotted both the target price and the actual stock price for advanced micro devices. This chart is drawn very well on Seeking Alpha. Other sites exist, but they're harder to view, so I captured this one instead. Here you can see advanced micro devices' actual stock price drop. Since this is the average of analysts' target prices, they don't all release their opinions at the same time every day. As time goes by, they keep updating, so the target price lags behind and drops like this. So it ends up dropping like this while maintaining a range where the difference doesn't get too big. Recently, as advanced micro devices' stock price surged, there was a moment here where it broke through the analyst's average target price. When that happens, the price surges again. Then we actually need to see if there was any change in the company's value during this period. If the company's value changes, we should raise or lower the target price. But even though it's not the value that's changing, but rather the price, the target price is still being adjusted. That's why I keep explaining that the target stock price is a different concept from the fair price, which is the company's intrinsic value. The target stock price is designed to always move with the current stock price. That's why when you invest, it's very important to have some kind of absolute standard, whether it's intrinsic value, valuation, or what we call the fair price, something that doesn't change as much and can serve as a reliable benchmark. I recommend that you also look at that kind of information. There are websites overseas. There's one place I know of, and that's Morningstar. If you go to Morningstar, I'm not a paid member, so they didn't show me the values. It's not that I deleted it. About 4 years ago, I signed up for an annual membership, but recently I haven't renewed, so I haven't been checking it. If you look here, they don't use the term target price. They're the only ones who use the term fair value. So they use the word fair value, yeah, and when the stock price moves like this, the fair value will be marked somewhere here. It shows whether it's overvalued or undervalued compared to that. And just like the target price we talked about earlier, the fair value doesn't change daily with the stock price. Because it provides a certain standard, Morningstar is doing a really good job. And when we used to do valuation modeling for our service, we referred to Morningstar's data and compared it with our calculated values. And Morningstar is very conservative. So if you are using Morningstar's paid service and the current stock price is lower than Morningstar's fair value, you can really consider it cheap. They evaluate stocks very strictly and conservatively, so if the price is below the fair value they provide, you can almost always judge that it's truly a cheap stock, since they don't overestimate the intrinsic value. So we compared it with ours, and for the typical so-called snowball stocks, the ones that grow slowly, companies whose profits grow about 10 to 15% a year, our valuation and Morningstar's are almost the same. Still, ours tends to be about 5 to 10% higher. But it's completely different for growth stocks. For growth stocks, our valuations are overwhelmingly higher. That's because we use a modeling approach that gives more weight to the valuation of growth stocks. So when the growth momentum changes, the weighting is reflected very quickly. And for stocks with rapidly rising performance, the fair value provided by Morningstar and the fair value our company provides, meaning the appropriate stock price, there's a big difference between the two. So I think our model is better. So anyway, as long as I keep working on it with pride, I just keep tracking those things to see if it really matches well, and I make all the data public and show the bands. So the same advanced micro devices that you see on our website is the advanced micro devices that we've been showing all along. What our company is showing here is what's marked as the appropriate price. This is the line right here, the one in the middle. This line is the appropriate price, but it's not the target price I mentioned earlier. It's closer to the intrinsic value, and we just label it as the fair stock price. Then when using this, some people ask questions like this. then at first, isn't it only cheap below this line? And once it reaches the fair stock price, shouldn't you sell? Aren't you supposed to sell here? A lot of people ask questions like that. What I want to say here is that target price and fair value are different concepts because the actual stock price doesn't always move together with the fair value, which is the reasonable price. It moves like this, sometimes trading higher or lower than that. Like this. Yes, so what I'm saying is that just because the stock reaches its fair value, it doesn't mean you should sell. Or just because it drops to its fair value after a correction, it doesn't mean you should buy. So what I mean by fair value is that it's just a point where the actual stock price passes by as it moves between being overvalued and undervalued. The stock price never just follows the fair value line and rises exactly along with it. So it would be good if you could remember that pattern. Then should you buy at this point or at that point? How do you decide when to buy? After finishing the theory, there's the momentum investment strategy the chief executive officer always mentions. So even if something is expensive, it can get even more expensive. And even if the valuation is cheap, it can get much cheaper. You have to keep that in mind because there are always intellectual limitations for people. And there are also limits to any kind of modeling. There is no solution that can predict the market perfectly. So you have to keep in mind that something may be cheap, but can get even cheaper. And something may be expensive, but can get even more expensive. That's because these things are created by human madness or fear, so they can easily go far beyond any mechanically calculated value. And when you keep those things in mind, you can use charts that show a bit of a turn, or use exponential moving average charts, or even use the artificial intelligence trading signals provided by our service. Along with this valuation, I think it will give you a much more comfortable opportunity to invest. So if you look at this service, or rather this chart, you'll see that the stock price, like we saw earlier, has dropped for advanced micro devices, but the intrinsic value hasn't decreased. But earlier, the target price set by securities firms also goes down together. So if you buy now and the target price keeps dropping, it feels like it doesn't matter whether you buy or not. But in this case, since the intrinsic value is holding up, when the stock price eventually rises back up, you can endure by understanding this concept. So there are absolute values called valuations, and it's good to try to recognize and calculate them as much as possible. But for beginners, it's not easy because there are so many different ways to calculate a company's value. So since our company is one of the companies that provides these kinds of things, I think it would be good if you could at least check these parts and quickly get a sense of how much the stock price is dropping compared to this level of value. The fair stock price we provide isn't a target price. For instance, if the fair price is $100 and the current price is $98, it doesn't mean the stock can't rise further. That's not the implication. It could go much higher. That can completely change depending on things like supply and demand. So when we say it's fair, it means it's neither expensive nor cheap. It doesn't mean that the price can't go up once it reaches that point. First, if you clearly understand the features in our service, I think it will help you use this chart much more effectively. The second is this. It would be great if you could make sure to learn these two concepts. So what this is about is somewhat related to investment philosophy. How I think about the market is called Hanyo Jong's investment perspective. And if you make that clear, you won't be swayed as much by the market's fluctuations. The first concept is called the margin of safety. I explained earlier what value is, right? The value of a company grows like this, but when the price goes up, it rises much faster than the value. And when the value's growth slows down a bit, if the earnings per share growth rate slows down or stops, the price tends to drop much more sharply compared to the change in value. This is a characteristic of the market. So you need to understand that price changes are much greater than changes in value. So even though earnings per share increased a lot in the past and it's increasing again this year, why is the stock price dropping? Then it's because the growth rate of value is decreasing. It's not that it's not growing, but if the growth rate decreases, the price can drop much faster. So it's really important to be aware of that concept. In that process, if the stock price drops excessively, these areas I've marked with a dashed line where the price is traded lower than the value appear, and that's actually a really good time to buy stocks. This so-called margin of safety means securing a safe margin. This means if something is worth a certain amount and I buy it for less, the difference is my margin of safety. Value minus price equals margin of safety. Buying companies with a margin of safety has two main benefits. The first is the investor's margin for error because you estimate the value and multiply it by a multiple to make your estimate, but the estimated earnings per share could be wrong. The earnings per share estimate may keep dropping, but if you buy a heavily downgraded stock, it's still cheap even if the company's value rises only slightly. But if you buy without this margin and just stick to the price when things go wrong or the stock price drops sharply, you could immediately face losses. That's why it's important to have the concept of a margin of safety. The second point is what's called Mr. Market. When I first learned about value investing, which was probably in the early 2000s, it's been over 20 years. Starting from studying the fundamentals and continuing on, one of the most taboo areas is this Mr. Market. Isn't Mr. Market supposed to go up and down? In the end, it'll follow the company's value. So if you just hold on, everything will go up. So if you go long, in the United States, going long has worked pretty well, but in Korea, that's not really the case. So value investing has been quite difficult in that kind of market. But the person who talked about this concept was Graham. Warren Buffett is considered the greatest master of value investing alive today, but his mentor is the one who came up with the concept of Mr. Market. The two most important concepts in investing are first, whether you buy something cheaper than its value, and second, whether you truly understand this concept of Mr. Market. So what is Mr. Market? It's the stock market. You have to know that humans are always irrational and emotional. Why does a company's stock price drop even when its performance improves? That's just the kind of place the stock market is. Yes, but now there are many questions on YouTube, and I'm sure they'll appear on your video too. People wonder why the stock drops even as earnings per share rises, but it does go down. Yes, that's how the stock market and Mr. Market operate. People wonder, oh, isn't this too expensive? Why does it keep rising? Yes, it's really important to recognize that this is how the stock market works. So even if the value stays at $100, the market mood changes. Yesterday, someone might offer $50 today, $150, and if you don't sell, maybe $300 the next day. That's how it works. That's why Graham compares the market to someone with bipolar disorder. So actually, this is when we get investment opportunities. When someone wants to buy at $50 or $150, or when someone wants to sell at $50, it's because of these differences that investment opportunities arise. You have to make these irrational and emotional fluctuations your friend. If you really hate these fluctuations, it's actually very difficult to profit from the gaps that occur because of them. So the concepts of margin of safety and Mr. Market exist in the stock market. So how do I deal with them? Am I by any chance Mr. Market myself? When the stock market falls, I saw the content said earnings per share will rise 50% annually for the next 3 years. If the stock price keeps dropping, like by 20%, I don't think it's right and will just sell at the lower market price. Then you become Mr. Market yourself. The important thing is that we shouldn't become Mr. Market. If you understand those concepts and control yourself when emotional changes happen in the stock market, I think you'll be able to invest a bit more comfortably. That's the end of today's theory. Now I'll move to the website and explain about 4 of the stocks listed on our actual service. While I'm moving to the website,
Let me just add one thing, the concept of a margin of safety. Actually, I think it has a lot to do with Warren Buffett. So many investors wonder why Warren Buffett doesn't invest in stocks we love, like Meta platforms, Nvidia or Tesla. They're often quite curious about that. Even though these stocks have risen a lot, they're top tier stocks with great growth rates. But the issue is, when Warren Buffett invests, one of his main conditions is how much margin of safety is secured. So as you mentioned earlier, even if his calculations are a bit off, he seems to invest boldly when he still feels the stock is cheap. But the problem with Warren Buffett is that most of the growth stocks we love usually have prices that are higher than the intrinsic value or fair price we calculate. If you focus only on the current value, there's usually no margin of safety and the price often exceeds fair value. And we still invest in those stocks because we believe in their growth potential. For example, in the case of Tesla right now, their cars aren't selling. In the near future, as new markets that didn't exist before open up and things like robotaxis or robotics develop, revenue that didn't exist before could increase exponentially. If that happens, the current valuation becomes meaningless. So in 3 years or after 5 years, there will be new sources of revenue that we can't even imagine right now. And at that time, cash generation will increase tremendously. Investing based on these calculations is the idea, but the problem is that these are just assumptions. And when you apply these assumptions to the margin of safety rule, it seems that value investors ultimately can't invest in Tesla. It's the same for Nvidia, as I mentioned. I saw on today's broadcast that Nvidia's stock has soared over 320,000% since going public, far more than 30,000 or 32,000%, and Warren Buffett missed out on this massive gain. But that's unavoidable. There has to be a guaranteed margin of safety. You measure value in cash. If you look at the current stock price, Nvidia's stock has never really been below its fair value. It's always been above it. But because the company has justified this higher price, the stock has kept going up. I think it's good for us to approach growth stock investing with this understanding. Yes, growth stock investing.
I think there definitely is something to what you just said, sir. So I have some questions about that part from earlier. And although it's not today, there will be a time later when I can talk about it. The value you pointed out as the fair stock price, at what point in time is that based on? For example, are you talking about today's fair stock price? Or is this company referring to the fair stock price 3 years from now or even 5 years from now? So that's why the current price can feel expensive or cheap. So simply asking whether value investing is about whether something is cheap or expensive compared to its current value. That's more like the first generation, like Benjamin Graham's era. But if you look at the second or even the 2.5 generation, most of them, and especially well-known figures like Professor Damodaran, invest a lot in growth stocks. He's also a value investor, but how does he approach growth stocks? Valuations should vary by each growth stage. Right now, the value may look one way, but in 3 years, it could be much higher. Even if the stock price falls between these values, you might still buy. I think investment patterns are shifting like this. Personally, I really respect Buffett a lot, not just because of his attitude toward life, but for many other reasons as well. Above all, it's not an asset size that we need to worry about. Even if he doesn't buy Nvidia, sometimes people probably ask you similar questions like, hey, this stock is better, why don't you buy it? Well, it's my choice, because
Even if I don't buy it,
I make a profit anyway, so rather than buying stocks that don't fit my style and worrying about them, I'd rather buy stocks I'm confident in and just go with that. Buffett is so large that even a 10% annual profit is more than enough for him. When we see people asking why he didn't buy something, individual investors often leave comments about it. But for me, it's like this. Just like we say, not to worry about celebrities. I think it's the same thing. So I always think, let's just focus on doing well ourselves.
no matter what someone buys.
Why didn't this person buy it? Everyone has their own style, so there are countless investment strategies. But just like the chief executive officer found a strategy that suited him and started incorporating momentum about 2 years ago, evolving his approach, everyone needs to find what fits them best. For some people, momentum just isn't the right fit. And when people start arguing fiercely on the keyboard, well then,
That person,
just do it that way. I'm fine with this. But people keep arguing about who's right or wrong, which feels overwhelming. That's why YouTube can be tough. Still, there are many good people on Chief Executive Officer NIM's channel, that's true. With comments like these, even though I'm someone who gets hurt easily, I can handle it and keep going. Something like this.
stock.
When I find a stock, people ask why I waited and didn't buy when it was rising. Actually, if you look at the weekly chart, it dropped to 1/5 of its value and then went up 50%. But because it recently went up 50%, people say, shouldn't you have talked about it before it went up 50%? If I introduce it before a 50% rise, people ask why when it's still dropping. If I wait until it rebounds, they complain too. With constant criticism, there's never a good time to introduce it. While you were away, Chief Executive Officer, I was nervous finding new stocks, but still active on the channel. There are so many people cheering me on like this. Like about 95% are supportive, so I just forget about the 5% and work hard. That's how I do it, and that's right. I also vent my frustration.
A little bit.
Then now I... Shall I say something? Yes, it's been a while since the choice type screen popped up. Here, now, as for advanced micro devices, I already once... I'll take a quick look. If you go into the valuation here, you can see it here. If you look here, over the past year, in 2024, from September, we're showing you the data for a year here, but actually we have more than 3.5 years of data. We'll also give you these long-term charts later. When you stretch it out like this, you'll be able to see whether this was the top and this was the bottom for the company, or if this was the top and this was the bottom. That makes sense. Each company has its own characteristics. So when you look at that, it'll be much more helpful in estimating in the long term that this is definitely the bottom. But even if you look at just 1 year of data, you can see a lot of these changes in stock price movements. If you look here, the line at the top is the overvalued area, the bottom is undervalued, and the dotted line is the very undervalued line. Here is the overvalued area. It's best not to buy at those times if possible, and if you did buy, should you sell? Don't sell right away, but it's better to sell when the supply and demand turns downward. I'll point that out as a trading signal, but the stock price could go all the way up to here, all the way up to this point. If we sell here, we might miss out on this much profit. Even if it's expensive, it could get pricier. Just look at Mr. Market, as I said earlier. Let's say it was undervalued and dropped, and I bought it here. If I bought it, I probably bought it at around $100 or $120. The stock price dropped to $70. That's right. Up until this point,
Because I'm a value investor.
I'll hold on until the end, but there aren't as many people who can endure as you might think. It's difficult. If it drops by about 15%, I start to wonder if I was wrong. It really bothers me to think that I might have made a mistake. I just want to erase it from my account quickly. After I do, I feel relieved, but then I see everything returns later. Situations like this happen, so don't buy. Just because the price dropped, you never know how low it could go. It actually fell all the way to this point. And when it turns and actually gives a signal, at that point we catch it with our trading signals. But you can use whatever you prefer, whether it's the exponential moving average chart or moving averages, whatever works best for you. Even if it rises later, since the valuation is already high, returns may be better if you buy at the bottom, but it might also fall further. We just can't be certain. Even if you just buy when it definitely turns and goes up, you can still get a decent return. I'm just trying to explain these kinds of things in here. But now it's back in the overvalued range, and we've seen a bit of a correction. If you look at the company's value recently, it's dropped a little like this. You might wonder, would advanced micro devices' value really drop? But if you look at the bigger picture, we don't just use one method for valuation. So sometimes we use revenue, sometimes profit, sometimes cash flow, and sometimes enterprise value, earnings before interest, taxes, depreciation, and amortization. We use all of these methods. Now we find the valuation method that fits this company best and use that model for our valuation. If you look here, if you check the company's recent financial results, let's look at it by quarter. We adjusted this table so that the data is easy to see, even on mobile. The text used to be small, but now it's much bigger, so it should be clear and easy to read on mobile as well. As you can see here, the operating profit is in the red. Earnings before interest, taxes, depreciation, and amortization has increased, but compared to last year, it has also decreased, and these are the kinds of things that lower a company's value. Sales have increased, but they're not currently valuing the company based on sales valuation. So these issues for this company happened because of other problems like export issues in China. If these parts turn profitable again, the valuation we saw earlier will likely rise in the next quarter. So since I know it's going to rise, I can also see when it will be cheap enough if it drops to this level, because I made this algorithm. So later, as I mentioned before, what we want to show you is whether the company's value will be here or here in the next quarter, or at least within the next year. Since we have estimates for a year ahead, I think we can show you that much. Then you'll have more points to look at over a much longer period. So we're planning to create and add those features for you later. Next, the next item. Let me take a look. I really want to cover this item, but since the Chief Executive Officer's broadcast was so long and intense today, I was wondering if it's right to cover this today. I'll just look at the valuation. When we did the United States top 5, if you watched the video where I picked this, you'll hear what I said. Right now, the valuation is in the overvalued range. But once the next quarter's earnings come in, I probably mentioned the price too. Since the fair stock price will rise sharply, I said at the time that it would be okay because it would be cheap then. Let me show you how things actually changed as the earnings were reflected. If you look here, the percentages here, here, and here. The fair stock price jumps a lot here, right here. You can see it shot up to here, this much. But since I know what valuation method they used in the background, I could calculate how this indicator would be estimated and change and how many times it could increase. So that's why I came that day. Manually, I could get a rough idea. So when we were broadcasting, it was probably around this point because it was a rapid rise. It's a bit overvalued, but since this price will be fair value later and it's this much cheaper now, I think it's okay to buy even now. That's the reason I explained why I picked it. So earlier you asked if value investors can't buy growth stocks. That's not it. People who see the value will buy them, and those who don't won't be able to. For example, a year from now, even though it's in this form now, what will Astrolabs' valuation be next quarter? I can calculate that too, because if we talk about valuation, if it's not the current situation, but if it changes like this, then I can figure it out. Then, even if the stock price is adjusted and stays at this price, it might be overvalued now, but after 1 quarter, it might not be overvalued anymore. Even though I just moved it up by a quarter, if I project this company's valuation 1 or 2 years from now, and let's say it's projected at $300 a year later, then at $200 it could just be considered cheap. So where I set my target point, depending on where I'm looking, I might be able to buy it or not. Earlier, I subtly asked you, sir, which period you're considering for the fair stock price. The reason I asked is because I plan to invest in this company for 2 years, and after 2 years, the fair stock price should be $400. But right now, it's $170. Isn't that cheap? If it more than doubles in 2 years, that's great. But if I'm only investing for a month and it's overvalued, I shouldn't buy it. So depending on how I assess the company's value and the time frame I'm looking at, the current price could be expensive or cheap. And it's not simply about whether the price has gone up or whether it's cheap or expensive. What's really important is how far I'm willing to invest and what the company's value will be at that time. So at our company, we've been trying to gather data from about a year ago and analyze that part. We're continuing to do that now. So I think this will be much more helpful for those of you who are planning for long-term investments. For Astra apps, company value is often assessed by consensus sales or profits. Sales growth rates are 96%, 30%, and 28%, with earnings per share turning positive at 34 and 46. Then I need to check exactly what I use for the calculation, but if I calculated it based on earnings per share, the fair stock price would increase by 34% next year and by 46% the year after that. If the fair stock price is $200 and rises 30%, it becomes $260. The next year, a 46% increase means multiplying $260 by 1.46 for the new price. If I did it based on earnings per share, I'm not sure about the exact earnings per share right now, so I can't tell you for sure, but that's the general idea. If I think it's worth $400, but it's $170, that's cheap for a 2-year investment. But if it just doubled and you want to buy now, you shouldn't. That's my point. So whether an investment is right or wrong depends on how long that person is looking ahead, what they think the fair value is for which year, and whether they're buying now. You have to talk about those things and compare your views. If you ask me what the fair stock price is, someone who's only investing until this month might say it's around $172, but people looking 2 years ahead might say, I think the fair price for this company is $350. Then the two start arguing about who's right or wrong, but the thing is, they're both correct. The current value might be $170, but someone investing with the idea that it will be different in 2 years arguing with others about this shows they don't really understand valuation. That's what these discussions are about. So it's about how far I should go or in what situations this applies. And I'm not saying you should buy Astrolabs right now, but for example, if you're planning to invest in Astrolabs for 10 years and you believe the company's earnings per share will grow by 20% every year for those 10 years, then you could just decide to keep buying it. It's not just about the current price hitting fair value, but about how far ahead I'm looking. And about earnings per share in the video that the Chief Executive Officer released on Thursday, I talked about finding growth stocks and skyrocketing stocks using stock price and earnings per share, which I showed you earlier this morning. If earnings per share increases faster, the stock price rises faster as well. If you focus on buying those kinds of companies, even if the valuation seems expensive now, it might not be expensive in 2 or 3 years. And for investors who invest that way, it's always possible to invest. I'm not referring to this stock. When I look at the comments, people keep saying that I mentioned a specific stock, for example, this stock. But what I'm actually trying to do is explain the concept of valuation. So you need to have these basic concepts firmly in your mind, because later on, when I talk about PR and expand on it, and also talk about PEG, you'll start to understand why PR is meaningful or not for certain companies, and when it matters more depending on the industry. So I hope you'll start thinking about these concepts little by little. Next, the second, I'll quickly go over just 2 more stocks and then wrap up. Tesla currently has a hold trading signal. At first glance, investing looks simple. Just spot undervalued and overvalued stocks, then buy or sell accordingly. So our valuation is a value that we provide exclusively. Like Morningstar in Korea, only our company independently calculates and provides the fair value for all stocks. All other sites just display the averages from the overseas data they receive. That's why the prices are different. So if you look here, even though it's expensive, it shows that it can go higher. As I mentioned earlier, if you look here, it reached the overvalued range, but it even went up to extremely overvalued. And here, even though it was undervalued, it could have dropped even further. So you need to approach these aspects with the concept of Mr. Market, and those factors are reflected in things like supply and demand, exponential moving average charts, and our trading signals. Since the analysis of the charts is already reflected, if you refer to those, you'll definitely be able to buy when the market turns. You can see the trading signals on this chart here. For example, if you look at Tesla over the past 6 months, there was a buy signal, and even though it seemed to turn here, we judged that the trend hadn't changed. But here we determined that the trend had turned, so we sold. We confirmed the returns and suspected something was off, but when the signals changed again, we started looking for another buy signal. However, the trend hasn't changed yet. If it changes again, it'll change, right? Right now, the stock price itself is a bit high due to overvaluation, but it's still maintaining its signal. So you just need to look at things like this. Next, if you look at the exponential moving average chart, it's right here. This is the exponential moving average chart we made at the Chief Executive Officer's request. When the 5-day line crosses above the 21-day line, it's bullish. Currently, the 5-day line is at $329 and $326 above the 21-day. But with the stock at $323, if it doesn't rise, this could soon become a bearish crossover. So if you look at the current stock price position and understand that it's still in the process of finding its direction, I think it'll be much better for you when you're looking at the valuation as well. TSMC is the last stock. As for TSMC, it's a bit... This is a different case, so I'd like to discuss it. Even with TSMC, if you only consider the trading signals, it's actually a well-captured case. Initially, the stock price fell sharply during a period of market fear. Despite advice to buy during fear, there was no buy signal for TSMC. People kept asking, well, what should I do? There's no buy signal for TSMC. That was a common concern. About that, I filmed and released a video last week. Because even so, individual stocks can have additional factors, so they don't always give a signal. And then at this point, when it was clear that it had broken through the tunnel, a signal was given. So even just the returns up to this point are enough. If you had bought here, you'd have made even more profit. This shows that Mr. Market is not something we can predict. So I think it would be good for you to take a look at those parts. Next, if you look at the valuation, this one, What's interesting is that we've always found TSMC to be expensive, so it hasn't been properly evaluated. If you look here, it's always overvalued. So if you're in this situation, we don't get any new buy signals. People who already own it will keep getting a hold signal, but if it's expensive, we absolutely won't buy it. We're really strict, but now it's dropped all the way down here, right? It's fallen to the undervalued range. And even at this point, we don't buy. We only buy when it turns. We wait for the turn. That's the difference, But there might be people who say, even though it hasn't turned, I want to buy TSMC at this level. So for trading signals or waiting and watching, you can use this and just keep accumulating and buying from this point on. It could drop a bit more, but you can make your own judgment. So your personal decision doesn't have to match the trading signals. We're just giving this as a reference, as a guide. You may think, I can buy now and dollar cost average for a month since it likely won't fall much more. Or I'd rather wait for a confirmed turnaround, even if it means paying more. In that case, it's best to check the exponential moving average chart or our signals. So right now the price has gone up and it's entered a highly overvalued zone again. Normally when it's overvalued, you would expect a sell signal. But for us, there's no sell signal and we're holding because the trend hasn't changed yet and it could go even higher from here. But while we were waiting and holding, what happened was that the fair value price went up after the earnings announcement. That's right, after the earnings announcement, the price that was previously considered overvalued has now become the fair value. So I'm asking, how many years are you looking at for your investment? I see TSMC at $500, but it's currently $200, so that doesn't make sense, does it? I'm discussing a 2-year outlook, so my point makes sense. You could buy now, and if you bought during the drop, this difference is called a margin of safety. The margin of safety means that even if my estimate isn't as high in reality, there's still a valuation range where I can profit. In the case of TSMC, it was overvalued, but as the company's value increased, it has now returned to a fair price. So, as I always say about the margin of safety, the value steadily goes up, but the price just moves up and down. So as long as the trend isn't broken, it's much more profitable to just hold on to companies whose value keeps rising. Please keep these points about valuation in mind. At our company, the fair stock price isn't a target, and reaching it doesn't mean the stock is expensive. Please keep this in mind. If you understand it as a price that is more focused on the intrinsic value of the company, it will help you as you start studying valuation and looking at investment indicators. It's been a while since I've talked about America.
This was an elementary stock lecture, and today as well, the content was truly invaluable. Especially when we start investing, honestly, in the early stages, studying companies feels difficult. Since we don't know many companies at first, we tend to invest in stocks we've heard of. And then for the first time, we start studying unfamiliar names. We look into what this company does, what it sells, check its growth rate, analyze various aspects, and study its business model. At first, this feels really difficult, but as you keep doing it, it gets easier and easier because it's repeated. But the really difficult part is definitely trading. It's really hard to decide how to evaluate this, when to buy, when to sell, whether I should buy more or cut my losses a bit. At times like this, there really aren't that many tools we can rely on. So earlier, you compared and analyzed various platforms. And actually, what you said about the target price set by analysts is correct. When the stock price drops, it keeps dropping along with it. And when the stock price goes up, it goes up together as well. Using that as an indicator is pointless since it's a lagging indicator. In reality, there aren't many indicators we can actually use. In my opinion, I personally believe that ChoiceStar's fair stock price is one of the very helpful tools that individual investors like us can easily use right now. Of course, we can't get it 100% right. I think your earlier explanation of Mr. Market illustrates that point exactly. Even if a stock price seems fair, no one can predict if the market will keep rising, drop more, or crash further, so you must consider that. Still, having a reference point is important. In that sense, I think it's worth paying attention to the fair stock price provided by Choisita, and of course, we make our own decisions. But using this as one of the indicators for making decisions has enough value. I'm not the operator of Choisita, but I wanted to mention this. Thank you. We also
After modeling, we keep updating it, thinking about how we can make it more sophisticated. We miss these growing companies, so we're always looking for ways to improve our modeling to identify them earlier. We're actively working on and updating this now. Algorithm changes for Astrohex help us catch these issues, showing how things are evolving now. Like I said at the very beginning, our service is at its worst right now. Every day, this is the worst our service will be, and as time goes on, it will become better than it is now. Yes. Then going forward.
I'm eager to see upcoming features and how accurately trading signals are detected, and I'll keep using it with anticipation. All right, you worked hard again late into the night today. You should get some sleep soon. No, it's nothing. We will end today's broadcast here, hoping you'll visit us again next week with more great content. Thank you for your hard work, Mr. Chief Executive Officer.
Thank you. You worked hard. Thank you. Yes.
Whether you sleep or dream, it's the beginning.
It's important to be ambitious, to grow little by little every day. Enjoy today's journey. Even if a dark recession comes, I'm not afraid. Retire with United States stocks. Yes. Oh, that's great.
The tone you're speaking with today is much more relaxed compared to before. Ah, really? Yes, I guess it's because you've been broadcasting alone in the business for so long. That's probably why. Yeah?
Alone continuously. Yes.
Alone continuously.